In its simplest form, there's only one thing you need to know when it comes to investing, and that's buy low and sell high. But how do we know when the price is low enough that we should be buying? And then if the price does go up a little bit, how do we know when it's gone up enough that we should be selling? I mean, maybe we bought a stock at what we thought was a pretty good price and now it went up a little bit, or maybe it went up a lot. But how do we know that it's not going to keep on going up even higher? Like, when is a good time? Is there any metrics to tell when a stock is cheap or overpriced? I mean, maybe we bought a stock at what we thought was a pretty good price and it went up by a little bit. Or maybe it went up a lot. But just because it went up a lot, does that mean that now is necessarily the time to sell? I mean, maybe. But maybe the price continues to go up. So how do we know when a stock is high enough that we should be selling or low enough that we should be buying? Well, unfortunately, there is no universal magical answer to this question. If there was, we would all be using this trick and we would all be rich. But what we can do is we can look at a handful of different ratios or multiples to try to give us some sort of an idea of how overpriced or underpriced a particular stock is. So multiples are basically a ratio, typically between some sort of earnings versus expenses. And there's a lot of different multiples out there depending on how you want to calculate earnings and all of the different accounting methods that can factor into some of these methodologies. And some of these multiples are going to be very industry specific. But one of the most common multiples that's used by pretty much everyone is what's referred to as the PE ratio, or the price per earnings ratio. So what a PE ratio is attempting to do is it's attempting to quantify just how expensive a particular stock is based on the amount of revenue that that stock generates. And so the official definition of how to calculate a PE ratio is going to be the price per share divided by the earnings per share. Now, the earnings per share, that's kind of a weird number. I mean, you can Google it. It's referred to as the EPS. But realistically, when we're trying to wrap our minds around what exactly is going on when we're determining this PE ratio, I think it's easier not to think of things in terms of earnings per share, because that's sort of an abstract number. So think about it this way. So let's say we have the XYZ Corporation, and they issue out 1 million shares of their company. And each share is trading at $30 per share. So in this case, the XYZ Corporation has a market cap of $30 million. That's the estimated fair market value based upon what the average investor is willing to pay for it. You have 1 million shares at $30 million a piece, so the company itself is worth $30 million. And then if that XYZ Corporation posted a profit last year of $2 million, what you would do is you would divide the market cap, that $30 million, the total worth of that company, divided by that $2 million in income that it had. And so in this case, that would come out to a 15 multiple, a price to earnings ratio of 15. And sort of another way to think about the PE ratio is how long is it going to take you for that investment to pay for itself? So if you had an income of $2 million on a $30 million company, it's going to take 15 years for that investment to pay for itself. So theoretically, the lower the PE ratio, the better. You see, when you have a very low PE ratio, that means that you have a lot of income versus what the company is supposedly worth. But just because you have a low PE ratio doesn't necessarily mean that the stock is supposed to be a buy. So a PE ratio in and of itself is just a static number. So you're going to want to try to evaluate this in regards to a few other metrics. So one might be, what is the rest of the company's PE ratios that is involved in the same types of business activities, what are their PE ratios? So maybe the XYZ company is involved in paper manufacturing products. They're trying to compete with Dunder Mifflin. And so they have a PE ratio of 15, but maybe some other companies have a PE ratio of 12 that's involved in the exact same paper manufacturing and distribution system that the XYZ company is involved in. But just because this other company has a lower PE ratio doesn't necessarily mean that they're the better company, that they're a better value buy at a lower PE ratio. So that could be maybe because the XYZ corporation has better growth potential. Maybe their infrastructure and their systems are just better in place so that theoretically they will continue to grow at a much faster rate than some of these other companies. And not only should you try to evaluate a particular company's PE ratio based against its peers in a similar industry, but you should also evaluate its PE ratio against the stock itself. What is its historical trends? So if we were to Google the stock Google, we would see that currently Google's PE ratio is sitting at roughly 30. So if we look at this chart of Google's PE ratio throughout the history of its stock price, we can see that a PE ratio of 30 is roughly average. But we can see this spike right up here where it gets to almost 60. So you can start to see instances where a particular stock has a ratio that's either significantly above or below its averages. And so if a stock is significantly above or below its averages, that might be a good indication that it's a good time to either sell or buy, depending on which one it is. And another problem with the PE ratio is that it is historical data, meaning it looks into the past, typically a year or so, to determine its revenue. And this can be problematic, especially for new companies that are trying to grow. So obviously we all know about the car manufacturing company Tesla. They are currently the most valuable car manufacturing company on the planet. I think they recently overtook Toyota as far as total market cap. But for a long time, they were losing money every month. When you're starting a new company, it's very difficult, especially these big, massive, like a car manufacturing company. It's almost impossible to be profitable right off the bat. And the same thing is currently going on with a lot of the various marijuana companies that are springing up in the United States and Canada. It's very difficult to be profitable immediately. A lot of times companies lose money as they try to establish themselves and grow. But some of these companies have tremendous growth potential. So even though they're losing some money right now, in the future, they're expected to profit by a large amount of money. So one metric that is useful then is going to be the forward-looking PE ratio. And that's pretty much the exact same thing, except with the regular PE ratio where it's looking at historical data, historical revenue. Now we're trying to predict future revenue with this forward PE ratio. Now obviously it's very challenging to try to estimate what our earnings in the future is going to be. There's a million different variables that have to be taken into account. And so there's really never going to be a 100% foolproof way to calculate the forward PE ratio, but it still provides us valuable insight as far as what we theoretically should expect. So by looking at these different ratios, the forward-looking PE ratios, as well as the historical ratios, we can attempt to identify trends within a particular industry or a particular company. And so when we see a particular company that either has a significantly high PE ratio or low ratio, that could be a good indication that it's either time to buy or sell. And identifying these trends of these PE ratios is one of the driving factors behind value investing. And value investing is basically the thought process that if you can identify a company that is undervalued based upon its earnings or based upon its historical averages or something like that, if you can find a company that is undervalued, then theoretically at some point the system will return to equilibrium, the price will return to where it should be, to where its true fair market value is at. And so if you're able to get a stock or a company that is undervalued and then it just goes back up to the fair market value, well then you've made some profit. So that, my friends, is multiples in a nutshell, PE ratios explained. If you like this video, be sure to subscribe, leave a comment down below, and as always, I'll see you all again next time.